Hey guys, so this is part 4 of the financial life hacks. So far what we've covered is we've covered your credit score, which is otherwise known as your FICO score. And again, that's like a summary of all your financial history that's boiled down to one number that represents you financially, how responsible you are, everything that you've done, loans and history, everything. And it's connected through your social security number. And here are the numbers again. You go anywhere from very bad, 300 to 560 to excellent, 750 to 850. And again, this number is so important because it determines so much in what interest rates you get on credit cards and loans, starting your own business, paying utilities, renting an apartment, and of course, getting credit cards. And again, biggest thing I wanted you to get out of yesterday is banks and these institutions are not your friends. They are trying to set traps to you in order to try to get some money out of you. Now, if you are paying attention, then you're gonna be able to see what these traps are. Things like this that we talked about yesterday, where they would offer you rewards points for a credit card, or a big coupon if you wanted to open up like a Macy's card, or if you want to buy a big purchase, 0% interest for 12 months. But again, knowing that if you don't pay back all the money in 12 months, they charge you all the interest on the first day of the 13th month. All those kind of things you don't know unless somebody tells you or you get screwed over by them. Bad credit, again, there's so many ways for you to drop your credit. Most of the idea is that you're being irresponsible one way or another. So here are those different ways. For you guys that you're young, no credit is better than bad credit. So you guys starting off your credit by getting a credit card from your bank and getting a utility bill like the water bill, the electricity bill, and paying it off month to month is slowly going to get your credit up. Remember, you start somewhere in the middle. How to improve your credit? Here comes all the different ways we discussed to get your credit up, but it all involves being responsible. It all involves making a plan. And it all involves not making any more mistakes because going up in terms of your credit score is difficult, but going down is really easy. And again, why? Because they made it this way. We also discussed interest rates, where based on your credit score, this is how much they charge you. And this is where I talked about whether you're going to get a baby slap because you're going to get hurt, whether it's going to be something like this, boom, or it's going to be something like this. Okay, but either way, you're going to get slapped with interest rates, meaning how much you're going to pay. So how much are they going to charge you? It's going to depending on on that credit score. So the better the credit score, the less it's going to hurt when you get a loan or buy a car or something like that, or even a credit card. The economy is what determines these rates. So the better the economy, unfortunately, the higher the rates. The slower the economy, the lower the rates. All right, and today we're going to talk about loans. All right, so again, loans is what you're going to go get from a bank in order to buy typically like a car or a home. And that is where the interest rate really pays off. So we're going to look at an example of buying a car. How much does the difference in interest rate really mean? So a car loan typically is 60 months, which is 5 years. So 12 payments times 5 years, 60 months is your typical car loan. Now it could be as little as 36 months, which is 3 years. And you're going to get really low interest rates because you're basically giving them their money back in 3 years instead of 5. And now they've stretched them out to 72 and even 84 months. So 6 years and 7 years to buy a car. And these are going to get the highest interest rates because you're taking 7 years to give them their money, so the interest is going to be high. What are some car loan interest rates that are good? So if you're getting 1 to 2% on your interest rate for your car loan, that is a great interest rate. And if you're getting somewhere around 21% interest rate, you're getting screwed over so much. And unfortunately, your credit score, if it's not good, is going to put you in these interest rates down here, which means you're going to pay a lot of money. But how much? Well, let's use this example of buying a $25,000 car. So $25,000 car is a regular size car, a regular loan. This is not a luxurious car for the most part, but it's not one of the basic ones, very bottom either. So typical month again is 60 months. So let's see what happens with your loan for 60 months. So if you're getting this 60-month loan and you get a 1% interest rate, meaning an amazing interest rate, you're going to pay $427 a month for that car. And overall, it's going to be $25,641. Well, you borrowed $25,000, which means you're only paying them $641 in interest, in extra money. So that's this one. That's that kind of a slap. Okay, you don't like it because you still got slapped, but it's only $641. If you move forward to a 5% interest, which is kind of like which is what in the range of okay or pretty good or decent, you're paying $472 a month. Just so the only thing that changes is not anything else. You don't change. The car loan doesn't change the length of it. The car, nothing changes but the interest rate. So from 1% is 427, 5% is 472. And that's like 50, $45 more a month. So that doesn't seem that bad. But if you multiply 45 months, $45 extra every month times the 5-year loan, now you're paying 28,307 back, which means you borrowed 25, so you gave them back $3,307 extra in interest. That's kind of a medium slap. But if you get an interest rate on that $25,000 loan, one of the high ones, let's go 18%, because your interest rate is horrible, your credit score is horrible. You're paying $635 a month. Remember, $427 for 1%, $635 a month. You're going to pay $38,090 overall back, which means since you borrowed $25,000, you're giving them $13,090 extra back. That's when you are basically getting one of these type of interest rate slaps. Yeah, same car, same exact situation. The only difference is this number on the left side. And what determines this number? Of course, your credit score. So you could also get lower amounts. So like say you have a really good job and you want to pay it off in 3 years. You get a 2% interest rate in 3 years. You're going to pay $716 a month. You're going to pay $25,778. So it's only $700 more. And then 72 months times a 2% loan, you're going to pay $369 a month because it's over 72 months instead of 36 months, but you're going to pay $26,951 extra. So it depends on what type of loan you get for $25,000, but obviously the best bet is to get a 5-year loan somewhere around 1 or 2%, and you're only going to pay them a little bit of interest rate. Now, do you get to decide? Of course not. They decide. And how do they decide? Your credit score. All right, buying a house is a huge, huge deal when it comes to interest rates, because when it comes to a house, it doesn't even change from 1% to 1 to 2%. There's 8 levels in between 1 and 2. So it's so it goes 1%, 1 and 8, 1 and a fourth, 1 and 3/8, 1 and a half, 1 and 5/8, 1 and 3/4, 1 and 7/8, and then goes to 2. And every single one of those eighth of a point makes your payment higher. So let's take a typical loan, which is 30 years to buy a home. Yes, 30 years. $500,000, which is kind of what a cheap house is worth right now, unfortunately. And you're going to hopefully get it, like, let's say you get lucky and you get an amazing rate like I have, 2.75 interest rate. My monthly bill is going to be $2,041. And overall, I'm going to pay them $734,000. So this is supposed to be an amazing rate. This is supposed to be this. I mean, it's supposed to be not that one yet. No, that one is supposed to be that little tiny slap. And I'm still giving them $234,000 extra of interest, because buying a house is extremely expensive when it comes to paying interest. That's why you want to get the amazing rate with that really awesome credit score that you have. But same loan, $500,000, same 30 years, and you're going to get a good rate, 5.5 interest rate. This is what my wife got on her house when she first bought it. Your monthly bill is going to go from $2,041 to $2,839. That's an extra $800. Why? This number right here. That's it. From this to this equals that. So that means you're going to pay $1,022,000 for your $500,000 loan with a good interest rate. Again, this is supposed to be a medium slap. And then you're going to get at the very end, the horrible credit score equals what my parents first got in their first home, a horrible interest rate of 11%. 11% on a 30-year loan. You're going to pay $4,762 a month, and you're going to give them $1.7 million for that $500,000. Why? Just this number right here. Same you, same house, same bank, same everything. The only thing, the difference was the interest rate from 2.75, an amazing rate. You're still paying them $234,000. Now you're paying them $1.7 million, which is $1.2 million more than the $500,000 loan you borrowed in the first place. They will screw you over. This is when you buy a home, is when your credit score is the most important. All right, and then school loans that you can get to go to college or university. Some of you will have to pay them back right away, and some of you will have to pay them right after you graduate. There are a lot of cool loans. when it comes to getting a loan for college. So let's say you get financial aid and they cover most of it, but you need a loan for the rest of it. You get a loan through a bank, and they have bank loans where basically they don't start charging you until after you get your degree. So once you graduate, they start charging you, and then you have hopefully you have a career job with your degree, and you're able to pay back that loan. But they're not going to ask you to pay back while you're still going to school. But it's only 4 years. So if you're one of the students that takes 7 years to graduate college, after 4 years, they're going to say, all right, we want some of our money back. All right, now what is co-signing? Actually, co-signing I will do on the next video. So we'll end here with school loans.